Hey, Renter Retires, it's Adam Schrader here, and we have a little bit different episode for you today. We recently had a webinar with one of our partner companies, PPR, because wealth building is a journey, and each phase requires a different strategy. And in the early stages, actively managed investments can generate the highest returns. However, as you accumulate equity and experience, some people reach a point where passive investing might become the smarter, more efficient path forward. So listen into this webinar that they hosted and see if it's right for you. At the end, don't forget, head over to rentsretirement.com, check out the properties we have there. The link to the PPR company will be in the show notes. Really appreciate the time y'all spent educating yourselves over this next webinar. Talk to you on the next episode.
Patrick, Dave, how you guys doing?
Unbelievable.
Doing well. Thanks for having us.
Tell us where you guys are located. You got to remind me.
We're just outside Philadelphia, which, in the Northeast, and it's a nice warm summer day, right, Patrick?
A little bit more than nice and warm, but yeah, I think you're over 100 degrees today.
So that means you guys are 2 hours ahead of me. So I really appreciate the time, being that it's later in the evening. I know our audience is super excited to learn about note investing. I don't want to steal your thunder, Dave, and I'll let you introduce yourself. But just to give everyone in the Rent Retirement audience a little bit of background. So as everyone knows, we love turnkey investing and real estate investing in general. Turnkey is a great way to be a little bit more on the passive end of the investing spectrum, or at least you have property management and you have some assistance. In my experience investing, while we love physical real estate, as I've grown my portfolio, I've realized that, man, time is really important. It's funny because everyone gets into real estate investing to try to get more time back, and sometimes we can do the opposite. As we grow our portfolio. So as I transitioned or wanted to transition more to a passive investor, I started to invest in more passive assets. I put a bunch of money into syndications, and then I lost a bunch of money into syndications. And then I discovered notes, Dave, and PPR, and working with you guys has been certainly a pleasure over the years. I personally invested heavily with you guys, and I will continue to do that. And I just think note investing is just a really cool way to have a diversified portfolio that is secured, that offers predictable return, that allows you to get your capital back in a reasonable amount of time. And I really enjoyed note investing as a more passive way to invest. So let me stop there. Dave and Patrick, guys, thanks so much for joining us. I'll turn it over to you in a second. Just a little bit of housekeeping items for everyone joining us in. This evening, we have the video and audio turned off and chat turned off. So if you have questions, this is where you get the best benefit from these webinars, is we bring in experts like Dave and Patrick here to share new concepts and things with you. So it's best if you engage and ask questions. They are here to educate you. Put your questions in the Q&A box, and Dave and Patrick will make sure to get to those throughout the webinar. So Dave, with that, I'm going to turn it over to you, let you share a presentation, and tell us a little bit about you and PPR.
Sure. Just going to share my screen real quickly here. Let me get there we go. Can you guys see me okay?
We got it.
All right, perfect. So you hit on the big thing, right? Passive income. And, this is definitely an inside look into PPR capital management. And we share the same sentiment, right? I was a very, very active real estate investor for, believe it or not, it's close to 40 years now. So I started real estate investing in 1986, 87, bought my first properties in 89. So long time doing this, was a landlord for about almost close to 35 years. So good long time. But, I was a co-founder of PPR Capital Management, and today I'm a board member, and actually still have a role there where I still assist with some deal flow and some capital raise things. But for the most part, I'm taking a secondary approach these days. I am also the author of Real Estate Note Investing. It was a book published through Bigger Pockets. I don't know if you can see that on there. Really blurry there, right, Patrick? So yes, like I said, my main focus is to try to help others to build and preserve their wealth, and to hopefully end up doing that in a more passive way. because, like Zach said, your time is extremely valuable, and it is tough to build a portfolio of passive investments. And a lot of times we're sold I don't want to say a bill of goods that real estate investing is passive in the eyes of the IRS, but in reality, it's very active. So I was definitely a person early on that was looking for ways to become more passive in my investing. Whether that, it was one of the reasons I invested in other things like storage or even commercial space, because I didn't have a tenant 24 hours a day, those types of things. I was always looking for a way to get away from that property management component. And I was a property manager years ago at Remax. So I had done those activities, and I saw what that was like. And sometimes you'll see people leave corporate America and they go into the active investing, and it's just another job in some regards, especially on the property management side. I am here today with Patrick McClatchy. He's from our investor relations team. And like we mentioned earlier, we're from the Philadelphia area. I'm also married. I have 2 adult sons. I have 4 grandkids. And I like to spend some of my time down south too in the wintertime. I'm usually in Florida. But so, this particular slide, I like to give this as a little bit of the state of the market for alternative investments. And if you think about investing in a private equity real estate fund that specializes in note investing, we're considered an alternative investment. And really, the gist of what this slide is saying is that the growth in alternative investments is extraordinary right now. And there was a time, a few years back where the typical financial advisor would recommend a client to invest maybe 10% of their portfolio into alternatives. Well, today you're seeing that change, and you can see just by the stats here, it went up to 20%, 25%. Maybe we might even reach 25 or 30% of people's portfolios starting to drift into alternative investments. And there's a lot of reasons for that, with the volatility in the stock market, things like that. Especially in the current environment, you're seeing all kinds of stuff. People like to have a little more diversification where you can, in a perfect world, have a multitude of non-correlated investments if you can do it, right? And we're just another vehicle that can do that. And PPR funds offer like an alternative to the public market volatility. And we have been able to show a pretty consistent, predictable return while preserving capital along the way. So PPR, we came from humble beginnings. Me and my partners, John and Bob, we started back in 2007. We were active asset managers at that time. We were investing, believe it or not, in the beginning in delinquent second mortgages. And then we grew and grew. And in the very beginning, it was our own capital. Then we raised some friends and family capital. We proved the model before we started to do that. And then eventually we started raising private equity. And here we are almost 2 decades later, still doing it. And it's grown quite a bit. Now, today we are more of a capital management shop. And, we definitely raise significant capital today and invest primarily in first mortgages on the mortgage side, as well as some commercial real estate for, like I said, more diversification. Today we have actually an economist on staff who's our CIO. He's really trying to build a really robust portfolio. And as we've grown, you need to diversify more and more, just, to reduce risk. And it's kind of like he always tells us the efficient frontier curve, right, Patrick, where we're trying to find that ideal spot on the curve where we're maximizing return on investment while minimizing the risk at the same time. And the best way to do that is through diversification. So this is a little bit about who we are today. Like I said, we're in our 18th year. We have well over 1,800 investors now, 1.2 billion of assets under management. We're fast approaching, I'm sure we'll exceed it this year, $500 million of equity under management. Do you agree with that, Patrick? We're going to hit those.
Yeah, absolutely. Sooner than later, probably.
And we've paid out a significant amount of preferred return over the years, especially in the Reliant Income Fund, which is our flagship fund. today we're right around 40 folks that work with us, and you can see most of them here in this snapshot. So we've grown quite a bit, and I think we're going to continue to grow. I didn't mention earlier that I had been the CEO for about 15 years, and today we have Steve Meyer, who came to us. I guess it's been about 2.5 years now that Steve's been in the CEO of the organization, and it's been a phenomenal ride right now. So it's exciting to watch where we're taking PPR going forward.
Hey everyone, it's Zach Master, CEO of Rent to Retirement, the nation's leading turnkey investment company. Over 800 of our investors have already joined the Rent to Retirement Academy, where they've learned how to buy their first or next investment properties in 90 days or less. Academy members are averaging 4 properties per year using creative strategies to fast track financial freedom. We teach you everything you need to know to be a successful investor from A to Z, including private lending, short-term note strategies, how to protect your assets, how to maximize tax benefits, everything you need to know to help you maximize your returns across the board. Plus, Academy members become immediate referral partners where you earn up to $1,000 per property that your referrals buy for life on every investment property purchase from all of your referrals. Last year, we paid over $160,000 to our top Academy referral partner. Our Academy enrollment is closing after the next 20 signups, and right now there's an exclusive 50% discount only available for the next 5 days. To learn how you can join our exclusive Academy program today to fast track your success, click the link below, and we'll see you on the inside.
So the Reliant Income Fund, this is our, like I mentioned, this is our flagship fund. It's really designed for cash flow. And, when I think of it, it's really a diversified income fund. And one of the things that's unique about PPR, like I mentioned earlier, we're a real estate backed private equity fund. But we have one unique thing that most private equity real estate funds don't have. And that is we have some forms of liquidity. And the reason we have liquidity is because a sizable portion of our portfolio is in these mortgages. Well, mortgages are much more liquid than hard real estate. And I think, the outside world doesn't always necessarily appreciate some of that. So, for example, we have a trade desk in New York where we can liquidate mortgages very quickly. We also have a line of credit where we can drop mortgages on our line and recapitalize. So what that does is it enables PPR to be very nimble and opportunistic in order to take advantage of particular deals that are coming down the pike, that type of thing. So we have this unique characteristic about our fund. And here you can kind of see the breakdown of, about 35% is in commercial real estate, and then about 65% is in these mortgage notes. And like I said, these are first mortgages. They're bank originated, institutional loans, and they're all throughout the United States, pretty much in all 50 states. So what is a mortgage note, and what is a mortgage? I'm assuming most of the people on this call are sophisticated enough to know what a mortgage is. Think about the mortgage that's on your primary residence, or if you have a rental property, that type of loan. And a note is really just a promise to pay, right? And a mortgage is the collateral piece behind that. So it's a secured loan, like Zach was alluding to earlier. And that's one of the biggest benefits of this. It's an asset-backed investment. And it was one of the things that appealed to me and my partners early on. We realized, hey, we can buy mortgages at a discount with a high yield with collateral. And that's what appealed to us in the very beginning. The other thing is, now active mortgage note investing is a little bit different. There can be some, more work to do on the asset management side. But when you're in a note fund, it is particularly passive. I mean, my mother's in the note fund, right? So it's like, she's 93. She doesn't have to do anything. It's mailbox money. That's what I mean by that. But it is still asset backed. Now there's like an extra step because you have a mortgage there, but it gives you true diversification. Like I said, where else can you instantly be diversified in like all 50 states, right? It's very hard to do that even on the commercial real estate side. And like I mentioned before, we get these at discounted prices, and that's how we're able to eventually add value to the portfolio. So, the typical purchase for PPR on the NPL side, the non-performing loan side, Typically, those purchases are around 25 to 100 million. The properties in there probably average between 350 and 450. There could be some lower than that. There can be some higher than that. That's pretty much the average. And like I said, they're first position mortgages in all 50 states. And you can see on this like capital stack snapshot that we're that senior debt. We're at the lowest risk of this capital stack. And I mean, that's one of the advantages. And a lot of people are, especially in the beginning, they're like, okay, PPR, how do you make money on a non-performing mortgage, right? It's like my partner John would say, counterintuitive. How can that be? And we typically exit these deals through the borrower or through the property. So just envision us buying a first mortgage at a discount. And if we exit through the property, a lot of times that could be through the foreclosure process, unless there's a deed in lieu situation. There's probably a good half a dozen types of exits. Now, if you're exiting through the borrower, it's usually through some form of a loan modification. A lot of times there's money paid towards arrears. And then what we do is we're able to share that discount with the borrower and, refinance that mortgage, so to speak. We'll actually rework that loan and modify that mortgage. We can extend the term. We can lower the rate. And a lot of times it is a little bit dictated based on affordability. Some of it is how much money can they put towards arrears and, any back charges that were added to the loan. It could be legal. It could be, other fees that can get added onto the mortgage, especially if they were delinquent. Now, once these loans are reperforming for a while, especially once they hit like 12 months of reperformance, they actually become worth par again, and we can actually sell them on the secondary market in bulk sometimes. Years ago, we used to sell individual ones. Today, we're typically selling them in bulk through our trade desk. But that's where a lot of the lift comes from. The other place sometimes on occasion happens is when the real estate values behind the mortgage go up in value. And we just went through a period of, high real estate values, for example. And probably the biggest economic indicator on the NPLs is unemployment. And the reason for that is there's four main reasons people default on their mortgage. It's usually death, divorce, job loss, and medical are the primary ones. And probably the biggest variable, like I was mentioning, it would be unemployment. So if unemployment ticks up, sometimes there's an increase in these types of mortgages. But for us, that in some ways can be a good thing because the more abundance in loans that are available, the cheaper the pricing is. Typically, it's the supply and demand equation. Usually the mortgage loans are priced in direct correlation to real estate values, just to give people color. So that's pretty much how we make money. So sometimes we're making money in payments. Sometimes we're getting arrears. Sometimes people are deeding the properties to us. Sometimes we're going through the foreclosure process. And if we take a property back, we have many of the options a typical real estate investor would have, where we can sell it as is, we can clean it out, we can fix it up, we can rent it, we can, we have all the options that a typical buyer would have. In fact, if anybody on the call goes to a sheriff's sale, the attorney for the bank that you would see at the sheriff's sale would be our attorney. And if you think about it, when we buy these loans, we become the bank. So hopefully that gives you some color into the role that PPR plays with these mortgages. So I do have a couple quick case studies. Here's one in Lindenhurst, New York. And I'm just trying to make sure I can see what I'm reading. The unpaid principal balance on this is $106,000 and change. We acquired it for $65,000 and change. And then we actually turned around and were able to sell this loan for $78,000 with a profit of $12,736. And you can see we were able to do that in 7.5 months. And this was an RPL sale. And what that means, this loan became reperforming. That meant an asset manager, one of our partners, who's our asset manager, reached out and they smile and dial to borrowers. They get them on the phone. They rework the loan and modify that loan. The loan becomes paying again. And then we probably lump that into a sale of other, of loans that got sold. So this is how we would make money on an RPL and you can kind of see the time frame there. Some of them take varying time frames. Some of it varies by state. A lot of it varies by where the borrower is at that given point in time. And you might say, well, how do you know all this? We used to be asset managers. We used to do these activities in-house. Now, here's another one in Crownsville, Maryland. The unpaid balance was actually just over $1 million. We acquired this loan for $321,000, and this home actually sold for $481,500. And you can see on the graph that the home's value was $525,000 though. So what happened there? It's kind of strange, right? Basically, they owed more than the house was worth, right? It was a little strange, but that happens. And you can see here we had a sizable profit, $159,000. It took a little bit longer on this one. It was 21 months. This was a deed in lieu, and then we, a lot of times, it was sold at an REO sale. So they deeded it back to us. It's like a bank-owned property, and then we turn around and sell that property, usually through an REO real estate agent. I don't know if anybody's familiar with real estate agents. There's some that specialize in REO property, which is another way of saying bank-owned property. And most REOs are properties that come back to the bank through foreclosure. This one actually happened to come back through a deed in lieu process where the borrower probably walked away and just signed it over. Sometimes it could be an estate situation, divorce, whatever that was. I don't know. I have the specifics on this exact one, but it just kind of shows you a typical deal, kind of shows you what's happening in the current market. One of the things that's happening right now, there's a lot of equity in the market, right? Real estate values have been up for us a while, and there's still been quite a bit of appreciation, even though it's starting to shift to be a little bit more of a buyer's market right now. But there's still been pretty significant growth and a lot of equity. There's also a time lag with non-performing mortgages. So by the time we get them, some of these loans could have been in default for a while or from a few years back even. Now, this is a snapshot of an actual trade. So the reason, showing you this is just to give you a little more color of how some of this can work. This is a situation where we bought 548 loans for $155 million. The unpaid principal balance was $153 million, but the total loan payoff was $227 million. What that's telling me is there's been a lot of late fees and arrears and legal building up, back taxes could be, and that's why that payoff's higher like that. And you can see where the property value is close to what the loan payoff is. It's close enough, but we're buying it at a discount, right? Now, so far off of this trade, you can see how much we've made, right? We've made $34 million. And you can see what's happened so far because some of these loans are still active, which means we still have them in our portfolio. So this is a relatively recent trade. You could see that we sold 176 REOs so far. That meant 176 properties went out to REO agents throughout the U.S. and were liquidated. And then we had some 117 in a note sale. A lot of times they'll package up various note sales. I know we did a couple so far this past year, right, Patrick, where they did, they'll lump together some NPLs and some RPLs, and then they sell them. And then there's some third-party sales, which could have been just sold to other third parties. And then you have payoffs where we got a payoff. Sometimes there's a discounted payoff. Sometimes family members step up and pay it off. Sometimes they get a job again and they refinance it and pay us off, those types of things. And then you can see the remaining loans. So we've already made $34 million, but we still have 40 active loans, 30 REOs left to liquidate, and we still have 18 mortgages that are cash flowing every month. And that meant they're modified and they're making payments, right? So it kind of gives you a snapshot into how PPR is able to make money. And this is how we're able to pay our investors on a monthly basis. And, a lot of times people ask, how can you pay those types of returns? And this is the way we're able to do that. Now, keep in mind, when we raise private equity from, investors like yourself that are passive, we're taking that capital, we marry it with some institutional money, and then we'll go out and make purchases. I believe last year we bought $375 million-ish in mortgages. Some of that's institutional money. Typically we're utilizing a Goldman or a Nomura, that type of thing. A lot of times it's a bank that does securitization work for us. And securitization is just a fancy word for us refinancing a pool of mortgages. And typically we do that. So we'll acquire loans like you see on this snapshot over time. Usually our typical funds will buy them over a 12 to 15 month period. They'll acquire a bunch of loans, and then they'll do a securitization, which is a refinance. And usually that's where a lot of these RPLs have become reperforming. We refinance that portfolio and we de-risk it. And we go into fixed rate financing, and then we wind down that portfolio, usually over about 33 to 36 months. And then we go and repeat that process again. So I know I'm saying a lot there, and I don't mean to lose anybody. But anyway, that's a little bit of how that works, and how we're able to pay those types of returns. Because some people will say, what you got to realize is if we take the private equity and we marry that with institutional money for say 75% of the money is institutional, that's at a lower rate. And if you look at the blended rate, that's what it enables us to get more of a spread to be able to pay our investors. So hopefully that makes some sense to folks. And then, of course, we do some commercial real estate, mostly multifamily. We do have some build to rent. We do some, I'm going to talk a little bit more about our opportunity fund as well. But the commercial real estate is in the Reliant Income Fund as well. And a lot of it's there for diversification. And everything that we do on the commercial side has something compelling as well, whether it's with our general partners that we work with. Some of these are value add type strategies. Some are affordable housing. Some are build to rent. You can see on this snapshot, there's a location in Austin, Texas, for example. What we liked about that was a new construction, new build. PPR is in and out of that deal in about 24 months. It's actually finished right now. It's getting ready to go on the market. And that'll be sold to an institutional buyer. And the reason being is it's an affordable housing project with LIHTC tax credits. And institutional buyers, that's very appealing to them. So that's one of the reasons we like that project. We actually have another one of those coming up. And you can see the one in Kansas City. That's a multi-deal that's like townhouses. And the reason we like that is we kind of like the build-to-rent models. And this is a multi-deal that's similar to build-to-rent because they are townhouses, right? And the reason we like those is, even though it's a value-add project on this particular deal in Kansas City, is people tend to stay longer when they have a garage and a yard and things like that. So we like that type of asset class. So there's always something compelling about some of the locations. Another one of the locations we have is near a big development area that's going on, where there's like a stadium and stores and restaurants, and it's an older complex. And we're adding value to that complex because we know the whole area around it's going to be taking off, right? So that's what I mean by finding something compelling. And then we have like a build-to-rent project, for example, in Knoxville, where even our counterparties have a secret sauce that we like, right? And in this case, they have an architect on staff, for example. So we're always looking for something that will give us a competitive edge in the marketplace. And then the other thing is, we have a local counterparty, for example, that's from our area that we got connected with from PPR's former CFO, actually works there, and they've been doing commercial real estate over 30 years. We love partnering with them. We get great reporting. They really know what they're doing, and they're the type of partners that we really like. So PPR is never really looking for a deal. We're looking for programmatic deal flow, if that makes sense. So we're very strategic and intentional about who we partner with, and we want long-term relationships. We're not necessarily looking for, two guys working out of their basement on a syndication. We're looking for, people that have a lot of experience and time under their belt and more predictability. So how can you invest with PPR and earn more than 14.3%? Well, first of all, I got to tell you how you can earn 14.3%. And that would be if you were to compound in our Reliant Income Fund. And I'll get into a little bit about the terms about what they can be at the end. So that is the highest return you can make in the Reliant Income Fund, and that is if you were to compound. But one way you can exceed that with us, if you were to invest in our other fund, which is an opportunity fund that actually invests in car washes. So I know on the commercial real estate side, I believe we're in 11 states with commercial real estate, but that includes the car washes. I guess it's about 7 states that are multifamily and housing related commercial real estate. But we have Tommy's is in 5 states. We have different assets that we're building right now. And there's a lot of reasons of why we like Tommy's car washes. And so we have a separate fund called the Opportunity Fund. And what's unique about that is it has the ability for additional growth. It has the ability for upside, where the Reliant Income Fund is just a straight pref return. And some investors like having more upside. This is a fund that these car washes actually are businesses too, right? So it's a piece of valuable commercial real estate on a valuable corner, usually near like a Costco or a BJ's, where there's obviously a lot of traffic nearby. So they're valuable corners, almost like you would see, a pharmacy or something. And but it's also a business as well. And there's a lot of unique depreciation tax advantages, especially with car washes, being that the structures of the car wash are part of the machinery. So it really accelerates that depreciation. Now you take that and combine that with fewer number of employees to run one of these. You have a recurring revenue model as well. And you have the latest technology and conservation of water, the volume of cars you can put through one of these car washes. And then the other prospect of what is our exit with these, we're actually working to build a portfolio with a couple of other folks and liquidate these, exceeding 100 of these car washes throughout the U.S. So right now, this fund is, it's a smaller fund. It only has a half a dozen of these car washes, and you can see the locations. We have one that's already built in San Antonio and Charleston. I believe they're building one right now in Fairfax, right, Patrick? And
Yeah, that's correct.
and then there's another one being built this year as well. And then the other ones will be coming online right after that. So I don't know, Patrick, is there anything you want to add about the car washes?
Yeah, a couple things there. Tommy's is a really unique model as far as a more modern way to go about it. Very favorable as far as customers and retention, especially with their subscription model. It can be favorable to have Tommy's locations close to each other. So it's not looked at upon with a few of Tommy's locations in the same city. It's not looked at as competitive, but the subscriptions do transfer to any locations in the city. Again, making it can actually be beneficial for locations to be closer to each other depending on the area. Beyond that, backing up a little bit what Dave said, Charleston, South Carolina and San Antonio, Texas are both open and operating. They opened in Q4 of 2024. And then the next two coming about would be Lincoln, Nebraska and Fairfax, Virginia. And then in early 26 is going to be Columbia, South Carolina, and then Mount Laurel, New Jersey.
And then once these are up and running, so to give people color on these, a typical project like this runs about 7 to 9 million. The revenues are typically 2.6 million. Operating expenses are about 1.4, and they tend to have an EBITDA of about 1.2 million. So an EBITDA margin of about 45%. And that kind of gives you a little bit of color. About half the people have the subscription model. I don't know if you said that, Patrick, you might have. So it kind of gives you some of the things that are unique about this type of investment. The car wash industry is still very fragmented. It's still mostly mom and pops. And private equity definitely has taken an interest in this vehicle. Actually, there was a sale of a large firm not too long ago that got a pretty crazy multiple. So that's one of the things we're striving to do here. Tommy's has been around, over 50 years. So it's a very proven model. We have a very good operating partner with this. So far, we've been having pretty good success. So we're really enjoying this asset class. And it has a lot of unique characteristics. So another way to diversify your income, significant upside, and substantial depreciation benefits with that accelerated depreciation. And that's even without bonus depreciation. If the big beautiful bill goes through, there could be even more depreciation available. But even without it, I've yet to see too much that I don't know what I can think of that has that much depreciation with it. Now, I'm a big fan of, I want an investment vehicle that stands on its own just from the income side, just from the business side. Like, I don't like investing in something just because it has depreciation, for example. I like to have a business that's profitable anyway. That's kind of the way I look at it myself. So these two offerings, just to break it down and recap it, the Reliant Income Fund has 3 different rate terms. One is 8% for 1 year, minimum's 50,000. It's 10% for 2 years, the minimum 75,000, or it's 12% for 3 years, and the minimum's 100,000. And like I said earlier, if you compound that 100,000 for 3 years, you'll get 14.38. Now, we do have a sister fund that allows qualified plans to come in. You can avoid UBIT that way. So a lot of investors do come in through 401ks and self-directed IRAs and Coverdales and HSAs and the whole gamut. I know, Patrick, you're there to help people out if they call in, that type of thing. Maybe you can take over the Opportunity Fund and give us the highlights of that.
Yeah, sure. So as far as the Opportunity Fund goes, it's a different structure than the Reliant Income Fund. It's an open closed fund, so essentially raising 20 million and then shutting it down. What it looks like for you as the investor, a quick synopsis of your investment. You're accruing a 10% return the entire duration of the investment, which we're estimating about 4 to 5 years until point of sale. Quarterly distributions, not monthly. I want to emphasize these are quarterly distributions, are projected to begin right in the middle of 2026, about a year from now, once all 6 car washes are open, operating, and cash flowing. And then you are included on the upside as well upon sale. I'm happy to go through the waterfall event in much more detail with you, but a very brief overview. Ultimately, the first 2 line items PPR has to take care of before making $1 profit on this deal is A, 100% return of capital upon sale, and B, ensuring all investors are paid whole on the 10% they've accrued and not been paid out on yet. Once that takes place, that's the remainder of the upside there, where you're essentially getting a 42.5% prorated upside. Again, this is an additional on top of the 10% you've already earned, which is why you see 18 to 24. So ultimately, your upside is projected to be an additional 8 to 14% on top of your 10% you were earning during the duration of the investment before the sale. And then again, just to wrap that up, $100,000 minimum for this fund, and qualified fund plans are also accepted in this.
Yeah, I was going to highlight one thing you said there, and it was about PPR being paid last. Is that what I heard you say?
That is correct, yes.
Not too many funds do that these days. So that is pretty unique. So in other words, the investors come first, which I like that. So I don't know if anybody has any additional questions. We covered quite a few things, and some of them can be a little complicated. Some of them are a little different. And that's largely due to the diversification aspect. Sometimes people ask us, why does PPR get into commercial? For example, a lot of people don't realize I came from commercial before I went into PPR, right? A lot of people don't know that. Even our CEO used to own a car wash, right? So we have a lot of experience, especially on the staff. We have team members that are well-versed in multifamily, commercial real estate. Our acquisitions team, our analyst, our CIO have a vast experience in a lot of these vehicles. And, just trying to convey some of that to the audience, because a lot of times you might see me, but you don't necessarily see the team behind us. So yeah, I would love to open it up to some questions. Are you able to see any Q&A questions, Patrick? Or hold on, maybe I can.
Yeah, can you post the earnings for each investment again? Go back to that slide. Someone just asked. And I can run through that again.
This one?
Just to emphasize the Reliant Income Fund offerings, there's 3 different offerings available. You can lock your capital up with us for 1 year and earn an 8% annual return paid monthly, or you can compound. You can lock your capital, and I'm sorry, that's a $50,000 minimum. We also have a 2-year lockup period. That's a $75,000 minimum. That's 10% annual return paid monthly, or 10.47 compounded. And lastly, we have a 3-year lockup period offering you a 12% annual return at $100,000 minimum, or 14.38 compounded.
So I was just going to add something there, Patrick, and I could just tell you some of the stories of strategies I've seen other investors do. And one of them is I've seen, like, for example, I had an investor not too long ago where he took I think it was 60% of his investment and he put it in the highest rate, longest term, and he got the compounded return. And then he took like 40% and he put it in, I believe, a 1 year, or it might have been the 2 year, but I think it was the 1 year. And he took a blended rate and he got some cash flow and he was able to get some liquidity by being able to get part of the money in a year. And then he was still able to get, the higher return by getting a blended rate, which was still like double digit. So it was kind of interesting to watch some of the strategies that some of our investors deploy here. And then we have other investors. I've seen one guy one time, he just does periodic investments. So he always has something that's maturing. And so I know it's not necessarily direct liquidity, but you can mix and match the 1 year, the 2 year, the 3 year based on what your needs are. And I've seen a lot of folks do that type of thing as well, and do similar things with the qualified plans too. If you can make 14.38 in a qualified plan without either tax deferred or tax free, that's a pretty significant return without having to deal with rental properties, for example. I know when I was a property manager, if I was able to see a rental property that was making more than 30% on PITI, I was starting to go into a dangerous neighborhood or something. If I was making less than that, but think about this, you also have maintenance and you also have property management, even if you're doing your own. And what's your time worth? So even if you're doing your own property management or hiring somebody, maybe it's at 8%. If you have a lot of properties, you might get it down a little bit, but still, between maintenance and property management, are you making in the teens like that, especially if you're making teens in a tax deferred or tax free account? It's very comparable to owning property without owning property. And that's kind of where I was starting to get stuck on some of these. That's why I'm more expansive today, Patrick.
Couple more questions here I have.
Sure.
The compounded returns mean you don't get the quarterly distributions. I think they mean monthly distributions.
It would be monthly distributions. In the Reliant Income Fund, you get ACH'd monthly, unless you choose to compound. If you compound, you would get your capital at the end of that term.
Do you own the anticipated locations for Tommy's Car Wash expansion? We do already own the land and permitting completed for the 4 that are still coming live. Do you have to be accredited for both of these funds?
Yes.
What is the monthly return to investors if we invested in the income fund for 2 years? Not sure the minimum. Go ahead.
75. Yeah. You have a calculator?
Yeah. So they're just asking what
75,000 at 10%. Divided by
Yeah, so
12,
ultimately-
pretty much. It varies by month and number of days, but it would be approximately that. It does go by the day of the month, like February's 28 days or whatever.
Yeah, so roughly $625 a month, at the minimum of 75,000 for the 2 years.
Yeah.
What would be the strategy if our payment we did not pay out to them?
Well, it's never happened. It's only been 18 years. I can't say past performance will predict the future. It would be extremely, it would have to be almost like meteor type stuff. I can't see the fund going to zero. That would mean like every asset in the fund became worthless because these are all asset backed, right? So, I mean, property values on thousands of assets would have to go to like zero to be wiped. You know what I mean? Like, I don't know what that would be a pretty ugly scenario. We are a company, though. Any company in theory could go out of business. I mean, Sears went out of business, right? But if you invest in PPR, you're investing in non-publicly traded shares of a company. The thing is that's a little different here is we do have assets backing us. And we've been through every cycle. When we started PPR, it was an up market. We went through the worst crash in real estate you can imagine. We went through COVID. We pivoted. You know, we've gone through multiple cycles. I really don't know what that would be at this point, because we do have some liquidity and things like that. We have a lot of flexibility. You know, it would probably be prudent for us, even if, you know, I don't know, the end of the world was coming, we would probably still liquidate at some phase. So I struggle to see where it would go to like zero or something. It would, because at that point it would be negligence on management if they knew they were going south and they didn't liquidate the assets, I think, because it is an asset backed. You know, I'm not saying you know, there could be a scenario where a fund paid, you know, 80 cents on the dollar or something like that. But I think at some point, it would be extremely rare. I don't know what that situation would be, but every asset would have to go to zero. I think that's another advantage of investing in a fund. The fund has a lot of equity in it right now. If you look at how much private equity we have and how much the value of the fund is, there's a lot of equity in there. I don't know if people realize how much equity there. It's significant. And you know, that's growing every day. As we buy these complexes and the value adds going on and the developments going on, the value of the portfolio keeps growing and the equity keeps growing. So I just find it, I'm not saying it's impossible and that it can't happen. It's just, I find it very unusual that could happen to any kind of a degree. And what I mean by having a diversified fund like this, nobody wants to take a hit, but a fund can afford to take a hit. It's the syndications that Zach was referencing in the beginning. When you invest in one asset in one location, it's hard to take a hit. Whereas a fund like ours, we could have an asset not do so well, and it might not matter that much because all the other assets are making up for it. And I think that's an advantage in some of the larger funds that you don't see in a syndication, for example, because all their eggs are in one basket and they're all in one location. I remember I used to think I was diversified. I had 40 places in the county I lived in outside Philadelphia. And today I look at that as a joke. That's not even diversified in my mind. You know, when I look at, you know, there's over 3,000 counties that we own assets in all over the U.S. And you know, we're really diversified. So if a particular state passes laws, you know, we have a lot more flexibility like that than most folks, you know, with the types of assets we have. And that's why, you know, banks are diversified in as many states as they are. Usually your biggest challenge is you don't have enough capital deployed to be truly diversified. And that's why it's hard for a single note investor. I personally had a single note portfolio, and I can't even compete with what PPR does because they have so much more capital to deploy. And it's the same way. I actually stopped buying apartment complexes and things like that because I'll just let PPR do it. It's easier for me to do that than for me to go out. Like, I can't do the amount of analysis that our 40-person team can do. I can't do the due diligence, the surveillance. I'm playing a fool's game to think I can do all that myself, right? And so I kind of have surrendered, so to speak, in some regards to where I limit what I do on my own with trying to figure out, you know, what assets do I want to invest in myself on a one-off basis and micromanage. As I get, you know, older, it just becomes a futile exercise. I'm better off just being in my fun. But that's just my way of looking at it. But Yeah, it is tough to be diversified as an individual, especially in notes. I mean, how many notes can you afford to buy as an individual? You know, it's just not enough. So the biggest risk is you. That's what I used to say. The biggest risk is you or me because I don't have enough capital to deploy. That's why you'll see smaller note buyers. They're very concerned about deed of trust states, and they're very concerned about legal timelines. You know why? Because they only have enough money to buy a couple loans. Bank of America doesn't do that. They're in all 50 states and all the U.S. territories and all, because they just have millions and millions of dollars and millions of assets deployed, right? So it's a capital problem is what it really is, that you're not able to be diversified enough.
That is all the questions we have for it.
Cool. That was great. Well, I appreciate you guys taking the time to listen to me and Patrick talk about PPR capital management and some of the things we do. And we'd love to hear some more from you folks. Definitely available to answer any questions. We have a sizable investor relations team, always ready and willing to converse and chat with you and help you, assist you in any way with any questions, any investment questions, anything that we can help you with. More than happy to, right, Patrick?
Yeah, absolutely. Thank you very much for your
Yeah,
time.
maybe I'll throw this up one more time, the link.
You will probably get scheduled with me. Happy to discuss anything in further detail. I'll give you more information on either fund.
All right. Well, thanks, Patrick. Thanks, everyone. And of course, thanks to Zach for having us on. Really appreciate having the opportunity to talk to everyone. Anyway, hopefully everybody has a great night. Thank you.
Take care.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.